Here's how it would work. The Bank of Canada can buy government bonds for cash. The government would pay the Bank of Canada interest on those bonds. But the single shareholder of the Bank of Canada is the federal government, which is to say, the people of Canada. That being so, the interest is paid back to the government as dividends. So the net cost of the money is just above zero, just the cost of administration deducted. The money that the government then spends into circulation on behalf of the people of Canada for various projects will end up in the private banks to become what economists call high-powered money. The private banks use this high-powered money as their reserves to increase their lending capacity, since greater reserves allow them to lend more to builders for infrastructure projects. In effect, the money creation system would be shared by the Government of Canada through the Bank of Canada and the private banks. During the first 35 years of operation, the intelligent use of the Bank of Canada got us out of the Great Depression, helped finance Canada's involvement in World War II, helped finance post-war infrastructure projects, the St. Lawrence Seaway, the Trans-Canada Highway, and our great airports, and helped lay the foundation for our social security network throughout the 1960s. This system of financing Canada's needs did not cause inflation, did not cause undue debt, did not adversely affect our foreign exchange, and certainly was not laughed at. But then in the 1970s that changed due to pressure applied to successive federal governments by the powerful, well-organized bank lobby, which convinced government leaders to forego the use of our own bank and to borrow as debt and at interest from them instead. And it's been downhill ever since.